Hello and welcome to our podcast regarding your super fund and action that needs to be taken before 30th of June. I'm Karlie and this is Angela.
Today we will cover some very important topics that trustees and members need to address before the end of the financial year. The items we will cover today are investment strategies, market valuations, off-market transfers, contribution caps, and minimum pension withdrawals.
So let's get started with the changes to investment strategies. Trustees of Self Managed Super Funds might not be aware of a number of new requirements coming about this year. The first of these is the additional consideration required when preparing your fund's investment strategy. It's always been a requirement for a super fund to have an investment strategy, but the government has recently announced that trustees must also now show that they're regularly reviewing these strategies. In particular, trustees must consider whether they should hold insurance for their members, such as life and TPD insurance.
So why have these changes come about?
Well, the tax office is aiming to protect members by making sure that you keep retirement assets secure so that the super fund can provide support for members in their retirement. Super fund trustees must now review the fund's investments and their investment strategy and make sure that they reflect the purpose and particular circumstances of their fund.
We're in the process of contacting all of our super fund clients to make sure that the review of your investment strategy has been done and that the documentation in place is sufficient and completed before 30 June. So now we will discuss the requirements to record fund assets at market value. The ATO have recently focused renewed attention on the valuation of super fund assets. From 1st of July 2012, trustees are now required to record all fund assets at market value at 30th of June each year. Previously, market revaluations were only required on a triennial basis. While assets are to be valued at market value each year, that does not, however, mean you will need an external valuation carried out for all fund assets each year. Trustees can undertake their own valuation, but must satisfy all conditions necessary to do so.
So what are the rules trustees are now required to follow?
Unless fund trustees obtain an independent valuation every year, they can either choose to perform their own or adopt a previous valuation they believe is still valid. Trustees must document the reasons for arriving at that particular value and must be able to demonstrate that the valuation used is a fair and reasonable process. The valuation must also be based on objective and supportable data, and all decisions must be documented in the minutes of the trustees' meetings.
So the documentation requirements to value an asset yourself sound quite onerous. If you are not comfortable doing that yourself, is it okay to use a real estate valuation?
Yes, there is no problem with obtaining a real estate valuation every year. Many agents even do so free of charge.
Yes.
It is important to note if the fund holds collectibles and personal use assets, there are further valuation issues to contend with, and it is advisable to obtain an independent valuation of these assets if at all possible.
So what happens if the fund's assets aren't recorded at current market value every year?
If the trustees do not value the assets of the fund at market value every year, the trustees can be held personally financially liable for not carrying out the valuation or having an independent valuation performed. To avoid any personal financial liability, trustees should ensure all requirements are satisfied in relation to revaluing the fund assets at 30 June every year.
Another new development in self-managed super funds relates to transferring assets into your super fund. It's common practice for super fund members to transfer assets held personally into their funds so that the asset is owned by the fund and income earned by that asset is concessionally taxed. The tax office is concerned that these transfers are not always occurring at true market values, and so that the tax office can be sure that all transactions are at true market value, they're bringing in new rules from 1st of July 2013 which will require any transfer of assets between an SMSF and a related party to occur through an underlying market where possible.
So what does this mean for our super funds?
This rule is likely to have the biggest impact on the transfer of listed shares. Currently, transfers of listed shares can occur via an off-market transfer as long as the transfer is done at market value, but there's often no record of how the market value was determined. Because the stock exchange creates an underlying market for listed shares, from 1st of July this year, all transfers between a self-managed super fund and related parties must be carried out via the stock exchange to prove that an independent market value was used. Transactions carried out via the stock exchange incur brokerage fees, so from 1st of July, a member will need to sell the shares on the open market and pay the required brokerage for this transaction. The member can then make a cash contribution to their super fund, and the fund can then choose to invest in shares that will again be purchased via the stock exchange and will incur more brokerage. So if members have shares outside the superannuation environment they've been considering transferring into their self-managed super fund, they have a limited opportunity to carry out any off-market transfers before 30 June this year and avoid paying 2 lots of brokerage fees.
So that covers the new requirements for super funds. Now we'll touch on a couple of housekeeping matters that happen every year and also affect the members of the fund. All members of super funds are subject to contribution caps. Contribution caps are limits the government has put on the amount of superannuation contributions you can make to your superannuation fund. This table outlines the amount of superannuation you can contribute to your fund for both 2013 and 2014 and what is expected to occur for the following year. Changes were announced to the contribution limits in the recent budget. As these are not yet passed as law, we will not cover them today. Concessional contributions are those which are contributed on your behalf by your employer or those which you have made personally and are eligible to claim as a tax deduction. The current year concessional contribution cap is $25,000. If this limit is exceeded, the excess is subject to excess contribution tax. Non-concessional contributions are contributions that no one has claimed a tax deduction for and are made out of after-tax savings. The non-concessional cap is $150,000. If you are under age 65, you can bring forward 2 years of non-concessional contributions and contribute up to $450,000 in one financial year. However, you cannot make further contributions in the following next 2 years. Maximising the concessional and non-concessional contribution caps and triggering the bring forward rule in the correct financial year can have great tax benefits and can offer tax planning opportunities. If you're interested in how these opportunities can work for you, please don't hesitate to contact us. We have helped a number of clients with varying sized super funds implement strategies that are saving them significant amounts of tax. You don't have to have a self-managed super fund to benefit from these strategies.
Many of you may be aware that when you start a pension from your super fund account, you must draw a minimum pension amount each year based on your age and the amount in your fund. If the minimum pension requirement is met, the earnings in your fund are free of income tax and capital gains tax. The changes announced in the latest federal budget may impact on the tax-free status of earnings, but these changes are not yet passed as law, so we won't talk about them today. Minimum and maximum pension withdrawal amounts are calculated based on the member's account balances at 1st of July each year and the member's age at that date. As shown in this table, the federal government has reduced the minimum pension amount required to be drawn from pension accounts by 25% for this current financial year. We have no indication yet as to whether they will retain the 25% reduction for the 2014 financial year, but it is expected that the minimum pension requirements will return to normal from 1st of July 2013. We'll be contacting all our clients currently drawing pensions from their funds in coming weeks to make sure that you're on track to meet your minimum pension requirements by 30 June this year. There are a number of benefits to starting a pension, so if you haven't already done so, please contact us to see if there are any opportunities for you.
So that concludes today's podcast on changes to self-managed super funds. These issues were covered in more depth in the seminar we held earlier this year. Detailed notes of that seminar are now available to purchase on our website at www.maxcamaccountants.com.au.